The Buffett Indicator just printed 232%. That's the highest reading in 100 years of recorded financial history. Warren Buffett himself called this metric the single best measure of where valuations stand at any given moment. And he warned us that anything above 200% meant you were playing with fire. The previous all-time high was 216% at the dot-com peak in March 2000. Before that, the previous extreme was approximately 200% in 1929. We just blew through both of those records, and almost nobody on financial TV is talking about it. Today, I'll show you exactly what the Buffett Indicator is, every historical extreme reading, and what happened in the months that followed, and why this 232% print is one of the most important charts in macro right now. All right, guys, make sure you hit the like button, subscribe to the channel, and check out the lifetime discount on TIA Pro. There's a link in the top of the video description, but more on that later in the video. Today, we're covering valuation extremes, the Berkshire cash position, the equity risk premium, the 𝗥𝗲𝗃 internal divergence, and where this all sits inside the 18-year cycle, because everything is connected right now. So let's get straight into the data. The Buffett Indicator is mechanically very simple. You take the total market capitalization of all US public companies, typically measured by the Wilshire 5000, and you divide it by the nominal US GDP. You express this result as a percentage. That's it. Warren Buffett introduced this metric to the public nearly 25 years ago in a December 10th, 2001 article in Fortune magazine titled Warren Buffett on the Stock Market, based on a speech he gave earlier that year. In that article, he wrote, and I want to read this directly, that the ratio is probably the best single measure of where valuations stand at any given moment. He also warned that pushing the ratio above 200% was investors banking on a suspension in economic gravity. The long run average sits somewhere between 100 and 120%, depending on the methodology you use. The current reading is 232%, approximately 67% above its long-term regression trend, roughly 2 standard deviations above the trend. Even when you adjust for the foreign revenues of US multinationals, the indicator still prints around 198%. That is still extreme by every historical comparison ever recorded. That means the total US stock market is currently worth 2.32 times the entire annual economic output of the United States. And the man who designed this metric, Warren Buffett, is sitting on roughly $373 billion of cash and treasuries of Berkshire Hathaway, the largest corporate cash position in the history of American business. That cash pile now represents close to 40% of Berkshire's market cap. 𝗥𝗲𝗹 officially took over as CEO on January 1st, 2026. And what has Berkshire done in 2026 so far? They've been net sellers of equities for another quarter while building cash, with only selective additions in energy and insurance. The man who wrote the original article on this metric is positioning exactly the way the metric tells him to position, so he's following his plan. So where does this all leave us in the historical context? I want to walk you through every prior extreme reading and what happened in the months that followed, because the pattern is unbroken. In 1929, the Buffett Indicator reached approximately 200% at the September peak. The Dow Jones topped at 381 points on September 3rd, 1929. What followed was the worst drawdown in modern financial history. You may have heard about it, the Great Depression. The Dow fell roughly 89% over the next 34 months and bottomed at 41 in July 1932. The market did not regain its 1929 peak for 25 years. In March 2000, the Buffett Indicator hit 216% at the dot-com peak. The S&P 500 then declined 49% over the following 30 months. The Nasdaq declined 78% peak to trough. In October 2007, the Buffett Indicator reached 137%. The S&P then fell approximately 57% through the Great Financial Crisis. In February 2020, the indicator hit 154% right before the pandemic. The S&P 500 then dropped 34% in 33 trading days, the fastest bear market in history, and we would have gone significantly lower without the Federal Reserve's emergency intervention on March 23rd. In December 2021, the indicator reached 200%. The S&P 500 then declined 27% through to October 2022, and in April 26, today, the indicator sits at 232%, the highest reading on record. 6 prior extremes, 6 subsequent drawdowns ranging from 27% to 89%. The pattern is unbroken across 100 years of data. Multiple monetary regimes, multiple Fed chairs, multiple industry revolutions, and every "this time is different" thesis published. Now, I've covered the Buffett Indicator on my channel, Jason Pizzino, several times over the last 6 years, and have always said it is best to follow the trend, which is bullish most of the time, rather than an individual indicator. However, that does not mean we pay zero attention to it. Rather, we respect the objective data, in this case, the work Warren Buffett has done researching over 100 years of data, and we learn how to use it in relation to the 18-year real estate cycle, which has been extremely accurate in calling every major financial peak and collapse over the last 220 years. That's right, you heard me correctly, over 220 years. Now here's where the bulls always step in, and I want to give them their dues because their objections are well rehearsed. So let's go through them one by one. Bull objection number one, rates are different now. The counter is simple. The 10-year Treasury yield is sitting at 4.3%, up from 3.95% in February. The S&P 500 forward PE is above 28. A PE of 28 implies an earnings yield of 3.6%. 3.6% earnings yield versus a risk-free 4.3% on the 10-year. Stocks are paying you less than the risk-free cash for taking equity risk in the most expensive market in 100 years. That is not a bullish setup. That is the equity risk premium turning negative on an earnings yield basis. So bull objection number two, GDP understates the modern economy because so many US companies generate revenue offshore. The counter, even when you adjust for foreign revenues, the indicator still prints approximately 198%. That is still above Buffett's playing with fire threshold. The adjusted reading does not save you. Bull objection number three, AI will deliver a productivity miracle. So the counter to this, the full year 2025 productivity growth came in at approximately 2.1%. Q4 2025 productivity was revised down to 1.8% annualized. Goldman Sachs projects US productivity at 1.7% through to 2029. Meanwhile, the four major hyperscalers, Alphabet, Amazon, Meta, and Microsoft, are planning to spend more than $650 billion on AI infrastructure in 2026 alone. That is a 60% surge from 2025. That is cost being capitalized into market valuations before the productivity has materialized. The market is paying today for productivity that does not exist yet. But that's nothing new, especially at bubble peaks. Bull objection number four, the Fed will cut rates and bail this out. Counter to that, the Fed already cut rates in late 24 and early 25, and the 10-year Treasury yield has actually risen from 3.95% in February to 4.3% in April. Mortgage rates went up. The transmission mechanism is broken. The Fed cutting at the short end did not transmit to the long end of the curve. Bull objection number five, earnings will simply grow into the multiple. Final counter. The current Buffett indicator is at 232%. The long run mean is roughly 115 to 127%. To normalize without a price decline, the market cap to GDP ratio needs to roughly halve. With nominal GDP growing at 2 to 2.5% annually and Q4 2025 GDP at 0.5% annualized, the math does not close. You cannot earn your way out of 232% with a slowing economy. Bull objection number six. This time is different. Sir John Templeton called those the four most dangerous words in investing. The most expensive sentence in finance. It has been wrong every single time it has been spoken. 1929, 1968, 2000, 2007, 2021. The data does not require a complicated thesis. The data requires you and I to recognize the pattern. Now, this is exactly the kind of macro environment where having a structured framework becomes critical, and this is why TIA Pro exists. We've got hundreds of members in the community now, weekly live stream analysis, live Q&A coaching calls, the cycle indicators we're using to time the rotation out of the equities and into late cycle asset allocations, and over 40 years of combined investor experience. There's a lifetime discount available right now and a money-back guarantee. If you're not ready for that commitment, there is TIA Starter for free with the weekly reports, Discord access, and the 18-year cycle mini course is out now. Link in the top of the video description. Now let's get to where this sits inside the bigger picture, because the Buffett indicator does not exist in isolation. The 18-year cycle, originally documented by Fred Harrison and refined by Phil Anderson, has tracked the rhythm of land value speculation and credit expansion for more than 200 years. Phil has been forecasting a major real estate market peak around 2026 for years now. This was projected as the winner's curse phase, the final melt-up before the cycle resolves. And every prior Buffett indicator extreme aligned with either the mid-cycle peak or the late phase of an 18-year cycle. This time seems to be no different. The terminal valuation extremes appear at the same structural position every single time. The smart money positioning is confirming this. Central banks bought 863 tonnes of gold in 2025, with the World Gold Council forecasting another 800 to 950 tonnes for 2026. Central bank gold reserves crossed $4 trillion in early 2026, surpassing the value of US treasuries held by foreign central banks for the first time in modern history. Gold itself touched an all-time high near $5,600 per ounce in late January 2026 before correcting back to $4,400 to $4,500 range. The US dollar's share of global reserves fell by 57% in 2025. That is not a bullish signal for the dominant equity index of the world's reserve currency. The internal market structure is also confirming the late phase. The Magnificent Seven now represents 33% of the entire S&P 500 index. That is up from 12.5% in 2016. And yet the MAG's ETF, the Equal Weight MAG 7 ETF, is down between 11 and 16% year to date. The 7 names that carried this entire bull market for 2 years are in the middle of a $2 trillion collective drawdown from their highs, and the index is masking it through concentration. That is a textbook definition of late cycle breadth deterioration. Q4 2025 GDP was revised down to 0.5% annualized. CPI is sticky at 3.3%. And this is a stagflation cocktail that preceded the worst bear markets of the modern era. So let's wrap this all up. The Buffett Indicator at 232% is not a prediction. It is a description of where valuations are right now. It tells you the setup, and every prior identical setup has resolved the same way. 6 previous extreme readings, 6 subsequent drawdowns. The cycle teaches one lesson every single time, and the only thing that ever changes is the headline used to convince retail investors that the rules have been suspended for them. In 2000, it was the new economy. In 2007, it was the Great Moderation. In 2021, it was the everything bubble, fueled by zero rates. In 2026, it's artificial intelligence and the productivity revolution. Human behavior never changes. The asset owners feel wealthy as the index hovers near record valuations. The average household pays 3.3% inflation on groceries, fuel, and rent. The K-shaped economy widens. And the man who literally invented the indicator is sitting on the largest cash position in corporate history while quietly handing the keys to his successor. The smart money confirms it. The internal structure confirms it. The cycle confirms it. The central bank buying gold for 15 consecutive years confirm it. And the indicator itself, the simple ratio of market cap to GDP, the metric the man himself called the single best measure of valuation, is screaming the loudest warning it has ever issued in 100 years of recorded data. Capital preservation in this phase is not optional. It is the entire game. Chasing the last phase of upside in this environment risks the next 30 to 50% of drawdown. That is the asymmetry here. That is the maths. That is what the chart shows. If you want the full framework we're using to navigate this exact phase, the indicators we're tracking, the rotations we're running across stocks, real estate, commodities, and Bitcoin, check out TIA Pro. There's a link in the top of the video description. There's a lifetime discount and a money-back guarantee. If you're not ready for the full commitment, no stress. There's TIA Starter, which is free. There's weekly reports, and the 18-year cycle mini course is out now. Now I want to hear from you. After everything you've just heard about the 232% print, where does this resolve? Does the indicator stretch to 250% or more before the cycle finally breaks? Or does this print right now, right here, mark the top? Drop your call in the comment section. I want to read everything, all of your theories down there. I'll see you guys back in the next video. Until then, take care. Peace out.